Welcome to Policy on Demand. I'm Scott McCandless. The Financial Accounting Standards Board, or FASB, recently issued a final standard on improvements to income tax disclosures. To discuss the significance of this guidance and what companies need to know, we're with Jennifer Spang. Jennifer, welcome.
Thanks for having me.
Could you tell us a little bit, starting off, what this financial standard requires and what it's seeking to accomplish?
So maybe I'll start with the accomplished part first.
Sure.
The standard, for anybody who's been following it, has been around for, I should say the project has been around for quite some time. It started back in 2014-15 time period. So it's been around, but gone through a number of iterations. But I would say consistent throughout the project, while the final standard, the objective was narrowed, it stayed focused on really the FASB responding to investor feedback that more transparency was needed in or with regard to income tax accounting or income tax disclosures, I should say. And in particular, disaggregation and around the foreign tax effects in particular, though the final standard goes beyond that. The final standard, what does it require? It's really focused on two areas: disaggregation around and incremental improvements around the rate reconciliation, and then disaggregation and incremental disclosures around cash taxes paid. So those are really the highlights, I would say.
You mentioned the word transparency. Can you talk a little bit about how this improves transparency for income tax disclosures, if it does in fact achieve that?
Yeah, the FASB would certainly say it achieves it, and really focused on disaggregation. So the disaggregation of, let's say, the foreign tax effects, which we can talk a little bit more about, it provides more information about the tax effects in specific jurisdictions, similar to cash taxes paid. So when you think about that disaggregation provides more insight from the FASB's perspective with regard to both risk, and when you think about cash taxes paid, really around where a company or an entity is paying cash taxes. So in a word, it's disaggregation.
You've mentioned companies, so let's turn to the folks that will be affected by this. Which companies are in fact affected? And can you talk a little bit about effective dates?
So the standard applies to any entity that's subject to income taxes. So that will include private and public. In GAAP, that's in this standard referred to as public or non-public business entities. So those are your two categories. So this is broadly applicable, but within the rules in the final standard, not all rules are applied the same. So there are different rules for, in some cases, public business entities versus non-public business entities. Now, as far as when it's applicable, it is applicable for public business entities for the annual period that begins after December 15, 2024. So if you think about that as a calendar year company, that means the annual reports for 2025, the standard has to be adopted. It will be effective. Now, in GAAP, there is always a transition method, and it can be a few different methods. In this case, it's prospective. So the standard provides that the changes would be adopted on a prospective basis, which would mean that for 2025, when you look at disclosures in the financial statements, 2025 would be under the new standard, and then 24 and 23 under that transition method would be under current GAAP. Now, it's important to point out it also, though, allows or permits for retrospective application. And in that case, what you'd be doing is you'd be showing all periods using the final rules in the final standard. The last thing that matters when you're starting to think about effective dates and adoption, early adoption is permitted. So technically, for any annual period not yet released, you could adopt the guidance. But importantly, while it was published in 2023, it's not applicable unless you're early adopting in 2023.
Sure, makes sense. Well, that's incredible detail about effective dates. Could you also give us a little bit of detail around some of the key requirements and what questions are you getting from companies to continue with their perspective?
Yeah, so if you think about the requirements, there's, I would say, three categories of changes that are in the standard. One, rate reconciliation. Two, cash taxes paid. And a third category is really including some changes that were previously exposed and generally agreed upon. And so for some companies, those will be important. There are some changes around both disclosures of uncertain tax benefits as well as around related to indefinite reinvestment assertions. But if we just think about the bigger stuff around rate rec and cash, so the highlights in the rate reconciliation that have attracted the most attention, companies, public business entities, which are required to do a rate rec, they will be required to disclose the rate rec using both currency and percentage. Today, they have a policy choice for one or the other, but it will actually now be required for you to disclose both for each year presented. So it's going to be a pretty big rate reconciliation. There are 8 mandatory categories, and the idea behind that was consistency across companies. So the categories are state taxes, foreign tax effects, cross-border tax law, changes in UTBs, changes in valuation allowance, kind of a non-taxable, non-deductible category. What am I forgetting? Tax credits. When you think about those categories, some of the categories will require further disaggregation. When you look at the state line, that's all state effects. When you look at the foreign tax effects, that's all foreign tax effects. And when you look at all of the other categories, you think about that through the lens of the parent's jurisdiction. So if I'm thinking about a US multinational and I'm thinking about the cross-border tax effects, I'm thinking on that line, I'm disclosing US cross-border taxes. So think about GILTI, for example. So that's kind of the layout of the rate rec, if you will. Within the categories that you require additional disaggregation, it's based upon a 5% rule. So that rule already exists in SEC guidance, but just for the rate rec in total. Now that will be for further subsections, if you will. So for example, in the foreign tax effects category, you have to disclose jurisdiction and nature of item to the extent either or both of those are greater than 5% of your domestic statutory rate. So if you think about, again, a US multinational, that's about 1%, just over 1%. That's a lot, but that's the rate rec from a public business entity perspective. Private companies or non-public business entities are not required to do a rate reconciliation today, nor are they required to under the final standard, though they do have some incremental disclosure. If we move to cash taxes paid, that's a little bit shorter. It's an annual disclosure similar to the rate rec. You will be now required to just disaggregate on an annual basis cash taxes paid by federal, state, and foreign, and then further disaggregate any jurisdiction where the net cash tax paid in that jurisdiction is greater than 5% of the total net cash tax paid. And I just want to stress on that. Those are jurisdictions. It's not necessarily just foreign jurisdictions. It could be a state. If to the extent a state was a material cash taxpayer for you, you could end up disclosing states. So then you asked about questions. I mean, that was a lot of information, but it all ties back into that. When we think about the questions that I hear the most, one is around materiality. So a lot of companies have asked the question of 8 mandatory categories, but what if a category is not material? The FASB did address that in both the basis of conclusion. The biggest picture is that materiality applies to all disclosures, and so that'll be no different for the final standard. The other questions are related, but it's categorization of items when maybe they fit into more than one category, but also this idea of what if you have 2 items that are related to the same transaction and whether you should be netting those items. The FASB addressed that, except there's 2 exceptions, but you should be doing it on a gross basis. But there is some netting in both your changes in UTB as well as your cross-border tax effects. And I just said changes in UTBs. That's a really important one I missed when I was talking about the rate rec. Let me just go back to that. That is probably the single biggest change that came out of the comment letter period into the final standard. So changes in UTB is a worldwide. You are permitted to disclose all changes in uncertain tax benefits on a single line item for worldwide changes. So this was a significant comment that came out from a number of respondents during the process that the disaggregation of uncertain tax benefits would be prejudicial. And so ultimately FASB solved that by just saying, uncertain tax benefits go on a single line for worldwide on the rate rec.
Got it. Makes sense. Jennifer, you've given us an incredible amount of detail, effective dates, some of the substantive steps they have to take. But let's take it back to the practical. What are some things that companies should be doing right now or considering doing in the near term as they go into this new environment?
There's really 2 things from my perspective. Again, unless you're early adopting, the standard is not effective for 2023. However, time evaporates, as we all know. And so it is important for companies to start preparing now and assessing where, for example, their systems may not produce certain disaggregated information that they need at the right level. And I would argue that using 2023 data is a way for you to test that system. So not changing part of the 2023 process at this point, we're into the year end in full swing. So not changing that, but thinking about how you use that data to kind of test and prepare for what you will ultimately need to adopt. But that ties into my second comment, which is the transition methodology. So it is prospective, but retrospective is allowed. Something for companies to be thinking about is how do they want to adopt the new standard? To the extent you do prospective, I mentioned earlier, you're going to be looking at apples and oranges. 2025 will look substantially different than 24 and 23. So if you were to adopt on a retrospective basis, then you would have consistency across 3 years. So again, it ties back to preparedness. If you think you might want the option of retrospective, after your close period, you could run the 23 data through a process that said, what would it look like under the new disclosures, such that it armed you with any gaps, as well as allowing you to run parallel for 2024, which would set you in a good place as you get into 25. So those are the two things that I think I'd encourage companies to be thinking about.
Well, great advice as always. Thank you so much for being with us, Jen. Appreciate it.
Thanks for having me.
And to our viewers, thank you very much for joining us. We'll see you next time.